Hello, ladies and gentlemen. Welcome to our webinar. I'm Joseph Novichov, Senior Analyst at GDMFX. Welcome to the first, not but the second advanced webinar this month. The first one, as you already know, was the psychology of trading. Extremely important topic towards the method, how you should behave on the market in certain situations, and how to overcome your emotions in order to, of course, get rid of them and get focused to more technical point of view, which we start today by the advanced trading the trend techniques. Today will be the first part of this webinar. We will be talking about the two directional trends, upward trend and downward trend. Next week's Wednesday webinar, we will continue with the second advanced trading the trend techniques, part 2. That's ranging markets, or the also called sideways trend. Extremely important thing to mention right now about today's topic, which we will be talking about the upward trend and the downward trend, is that whatever we've been teaching you guys in our basic webinars on how to recognize the trend and how to trade with it, everything stays put. Everything is valid. However, in this webinar, what you will grasp would be how you can use technical indicators, how to set them up in order to get a better visual picture over the movement of the trend, and how to spot better entries and exits. Now, everybody knows the trend is your friend until it ends. However, in many cases, as you can see here on the chart right now, the most common traded currency pair, Euro-USD, we have the daily chart. Now, we will be focusing, let me amend this, until the rest of the month, every webinar will be focusing from the daily charts to the smaller time frames, not vice versa. Because we are talking about more advanced trading, more advanced technical analysis, that concerns pretty much those traders that have actually considered trading to be their full-time job. That's why they need to look at the bigger picture. And that's why they need to use technical indicators to support their theory of the direction of that current established trend, and how to recognize those false breakouts of the trend line. Everybody knows that a trend line is exactly what you need to follow the trend. But in most cases, when the market is so powerful, so steep, and the trend goes and goes like months in time, during that whole period, the trend line stays intact. Basically, when you see the price moving so far away from it, you can barely find a suitable place to enter multiple positions. So basically, our focus today would be finding the better entries if we're talking about a downtrend, the one that you see currently on your chart. And as you can see, this is since April this year. The trend haven't even ended yet. So this is almost a full year of downward trend. Why losing that? You can see this is so much money that you can make in 1 year, only by following that trend. Because anybody out there tells you there is a strategy that hasn't involved, that does not involve trend following in any way, it would be the biggest liar over there. Everything is according to trend. Doesn't matter what direction it is. Everybody knows markets are found by the Dow theory. So basically, Charles Dow was the one that actually presented the trends as a fact. First was an idea, then became a fact that markets move in trends. Now, I'm not going to go too much in the little things, those which we already know about what a trend is, how to identify it. What I need you to focus on right now would be why the trend line is not the best option to follow a trend. Now, let's imagine we have an established trend. Now let's mark point A from where the trend has established, from where the trend is starting, let's say. And then we have a new high, point B, from where we should measure the highest and lowest point between those 2 points and find where we should place our trend line by measuring whether the retracement is between 33 and 66%. Our old and very well-known technique to measure whether the trend would be sustained. Now, after we know that, we place a trend line connecting the 2 tops of those points. So what you see here, ladies and gentlemen, is that the trend continues for just a little bit until it ends, obviously. The price starts heading above the trend line. This is a very good point here to remember, that using a trend line not always helps the trader to follow that trend. You need something else. That thing that you need right now is to leave your Fibonacci retracement tool for as long as it's necessary for you to measure a breakout point from the zero level. This is the very important zero level from where you should enter your trend, and you should expect that the trend will be sustained. Not only you will need an additional tool, a moving average, which is with a 14 period, something we already spoke about in the previous teachings, but what you will use the moving average is instead of a trend line. You don't need to draw a trend line every time you want to establish a current directional trend. What you need to do for most advanced traders that are focusing on a bigger time frame, now, you need the trend to continue for as long as it's necessary. That means 3, 4, 5, 6 months. Along the way, you will be trading on the smaller time frames for multiple positions. Or if you are an investor, or if you prefer to have an exposure, you still need the bigger picture. Identifying major trends is the most important part of today's teaching, and following it. The most appropriate way is to use the Fibonacci retracement until the price clearly breaks below the zero level. Using a moving average of 14 period will help you enter multiple times. As you can see, the trend ends at some point over here, retracing back above the 33% on the Fibonacci. That's why you have no idea whether a trend will reverse to the upside. What you need to do is wait until it goes below the Fibonacci zero level, from where you will start following that trend by shorting that instrument every time the price touches the moving average. This is another way from where you can follow that trend in one direction and close all of your positions at a point. I will show you where. This trend is clearly over for some time, until, of course, it starts moving sideways, something that we will be talking about tomorrow before it breaks the same direction. Now, what we need here to remember is that in those cases, trend lines can help us identify short-term trends better than the long-term trends. Even if you connect this particular trend here, it's not really going to give you too much of a good way to find a better entry point, because you would be expecting the price to bounce off this trend line. The thing is, the world isn't that perfect as we all think. That's why we need that moving average to smoothen out a little bit our price so we can follow that trend properly. As you can see, along the way from here, somewhere in July until present day, somewhere last month, end of October, the trend is clearly over, goes sideways. So what we have here in the multiple positions, one position here, position number 2, position number 3, 4, 5. You can see multiple positions which you can enter. Now, this is a technique I've been following for a very long time. That's why Fibonacci retracement should be left as long as it's necessary the price to break below that zero level, or if we're talking about an uptrend, it's still the zero level because we're measuring the other way. So that's something you already know, and I'm not going to go over it. One thing very important here to remember is that we need to use the relative strength index to help us identify at what conditions the market is currently. Now, if you remember our last teachings about how to identify entries and exits, we've been using different setup for our chart. But as long as we're talking about a longer time frames, we need something that it's acting a bit more faster than it actually is. And that's why the best option to use the relative strength index is to use it with a setup levels 70 and 30. You do not need the additional oversold and overbought conditions. As we mentioned, you don't need the trigger points 50, 60 levels if you wish. You only need the custom, basic levels of 70 and 30. As I mentioned, we're talking about a larger time frames. Parameters, we're going to use a period of 5 for the relative strength. It's very important. Now, as we time it, aligning the time is something extremely important here to remember. Let's actually use directly this one. Now, in the point of a breakout, we can see that the price is firmly holding in oversold conditions. Once we see that the price moves in oversold conditions, we know that the price is trending, that the instrument is trending. So what does that tell us? It tells us that the relative strength index is extremely a good instrument to trade the price even on sideways trend or upward or downward trend. Now, the only difference is that when we're talking about upward and downward trend, the price will stay in oversold or overbought conditions for an extended period of time. And this is what we need to see. Okay, now let's talk about our entry. We know that the price is clearly breaking below the zero level here. We know that the price is in oversold conditions. We already know relative strength index will stay oversold until the trend is over. What we can see here is multiple entry points where the price is bouncing above that line. Very important part here, when the price clearly goes above the 30 level, we should switch to smaller time frames to find better entries. Now, me personally, I don't need that smaller time frame. Daily chart is absolutely enough. As you can see, those techniques are accurate. The 14-period exponential moving average is acting as a perfect trend line, better than anything else. However, the relative strength index will show you in which conditions the market currently resides, whether it's in overbought or oversold conditions. We're using a bit of faster relative strength, as we mentioned, period of 5. We want it to move a little bit more faster than normal so it can give us more trigger points. Now, if we align it like we did the last time with a 14 period, the price will stay in oversold conditions for the whole period of time of this trend. However, what we need is an entry, not only when the price is hitting the 14 exponential, but when the price is close or at overbought conditions in this downtrend. to give us multiple entries. Let's align it in time and see all those oversold, overbought conditions on the relative strength, how they align, to see what it gives us every time we have a position opportunity where the relative strength is at the moment. Every time the relative strength gives us a signal to enter, it's above the 30 oversold conditions, and the price is bouncing off the moving average. And why we know that the exit is somewhere around this line here? You know, it's many days without a development of the trend. You know, we are either going to expect the trend to reverse to the upside, or it's going to stay sidelines for an extended period of time and then continue to the downside. Those are two question marks which we cannot really consider as a positive point of view for our trading experience. That's why we can see that the relative strength index hits overbought conditions at the level of 70. We see that the price is clearly staying for 2 days above the 14-period exponential. We might say this could be just a false break. We will sell one more time. But we see that the price is closing way above the oversold conditions where we need to see that relative strength. We need to see the price resides down here to suggest that the trend continues. If the price stays above that oversold level, we know that it's going to be sidelines movement. So we exit. Even if you exit at the very top of this one and you make a mistake, for example, still those profits that you have along that way will cover way too well this negative experience over here. However, if we're well protected and we know that when the first time the relative strength closes somewhere around this level, which is above the 30 level here in oversold conditions, we know clearly trend is over. And there is nobody that is going to argue with that. This is the place where I should mention, guys, whatever we're doing with those a bit more, more advanced strategies here, is that everything is connected. Some of you haven't been here the last time on our webinars, on our psychology of trading, where I mentioned that every webinar is connected. Because at the end, I will show you a very simple way how you can choose the perfect strategy for the perfect moment. How you can choose to use trend following strategy, how you can choose to find whether you have to use a ranging market strategy. You will find out at the end of the month. And of course, for the first time in our webinars, we're going to talk a little bit more about Elliott waves, something extremely important for daily, weekly chart traders. That's why we're squeezing it in, and we're going to talk quite a lot about it. It's a lot to tell. We're going to count the waves, but that's going to be left for later this month. And at the last webinar, which is going to be more like a seminar, I will invite you all guys to participate and of course to ask questions or just to share an opinion. Basically, a live discussion on everything that's bothering you on the market, every mistake or progress that you've made on the market. This will be the place where we're going to talk about it. As we all know, for some, of course, group sessions might be inappropriate if the trader is a bit more conservative and wants to keep his experience, in a tight circle. We can do that on a one-on-one session as well, so I can help each and one of you individually. Right now, I want to reevaluate what we've been talking about so far. Trendline is a very good tool to use, but when the price goes so far away from it, it rarely gives us a very good opportunity to enter the market. You will be thinking every time the price makes a new low that it's going to start bouncing up to the trend line itself. That's when the people make mistakes. They think that the price has to go to the trend line. They're actually right. It will go there eventually. But it might not be today or tomorrow or the day after. It might not be in the next 1 or 2 weeks or maybe months. That's why the perfect setup of a chart is the best beginning of a successful technical analysis. And identifying price direction gives you an opportunity to multiple times enter the market. Every time you will notice why the screenshots that I'm taking are on 4 hours or daily chart screenshots. It's basically because it gives you this bigger picture. And sometimes I'm even making you more screenshots so you can see how better to enter in the market. Unfortunately, we can't really provide you with investment advice. Therefore, those recommendations are just to guide you to the right, in the right direction, of course. One thing I would like to mention again, the relative strength index is something that you cannot really use to trade the trend, but it's a very good tool to show you where the market is at this moment, because it doesn't matter if it's in oversold or overbought conditions. Okay, the rules doesn't apply to the relative strength when the market is trending. So when you have a downtrend or an uptrend, the market will always stay in overbought or oversold conditions. This is where the people make mistakes when using the relative strength index. When you guys begin to understand how the relative strength is taking those levels to measure oversold and overbought conditions, when you understand the formulas, you will evaluate what I'm telling you right now. Follow this strategy the way that it is, and you will see the success into your accounts. Now, one more thing I need to mention here. Those advanced strategies that you will witness here in this month's webinars are not really suitable for small investors, small traders, let's put it that way. I mean, small account traders. Basically, you might need to hold on to a position for a full year if necessary, because the trend continues. That's why you need to have a margin for that. That's why do not make any, don't try making any kind of experiments with an account of $100. It's not really going to work. It's most probably going to wipe you out. If the price heads up to your direction, your expected direction, to the way you are predicting it really fast, it makes you a very good profit, for example, so you can hold on to. That would be just a mere luck. So for this type of strategy that I'm presenting, me personally, I believe an account above $2,000–3,000 is most suitable, and you have to understand that the size of your positions should be extremely small again. So basically, the way I've measured this strategy, on only one position, on only one lot traded, for 3 months, you're able to make $6,000 on one position with one lot. This is the average best success rate for this strategy. And I'm talking about the whole strategy, not just this one. I'm talking about the full setup of the chart, because you will see here every day when we have a webinar, additional oscillator or something else will appear. We will be building on to get to our exit point from where you will be able to see the full picture of this particular strategy. So this part today of the webinar is just the beginning of it. How every now and then I've been asked how do I pick those levels? You know, those moving averages, those relative strength levels as well. It's not only the way that I've been testing these strategies. It's pretty much a research. You know, people make a research first, then they start testing it, then they start improving it. So everything that you see here is not only tested, but it's been improved from the months and years of trading in the past. Let's clear that chart a little bit. As I mentioned, even last time, I don't know if you guys remember what I meant, is that we will use multiple different instruments to spot one and the same thing. Now we've been using the euro dollar. Anybody have any suggestion on what you want to use? Gold, GBP, anything else? Just make a suggestion and we will talk about it, and we will take it as an example. You know, everyone has, let's say, different favorite instruments that you're using. So I want to make an example of today's strategy on each and one of it. Now this will be the basic layout. That was the basic layout of from where we're going to start building on it, and at the end of the month, as I mentioned, you will see the clear picture of it. Let's use the second of importance, the GBP versus the dollar. Let's clear out a little bit the chart. All right, we still have the daily chart. We have the current established downtrend on the pound versus the dollar. As you can see in a moment of time when the trend clearly was over, but then it started continuing to the downside. Now this is something that we will be talking about in the Elliott waves, how you can spot that movement and how you can actually expect the price to continue to the downside. Some of you might be already familiar with that, but I still want to, you know, cover it. It's one of our topics. Let's see what the trend line is doing. We have a clear established trend. Even if we measure it, it's still going to be the same. Now clearly the trend line here is not really giving us a very good idea of what the trend is doing. But if we make the same setup as we already did with the same moving average, you can see how the price is bouncing off of it. You can see how good it does. Same basic layout of the relative strength. You can see the prices residing in oversold conditions for an extensive period of time until the trend is over. So you can see here when the price went above the relative strength, the price was still below the moving average, but that's an early hint that it's going to stay above or it's going to keep going up. However, here the relative strength helps us identify that the trend most definitely will continue to the downside after a short period of sideways movement. That will not only happen once or twice, but it's going to happen every time. The relative strength is an important indicator, especially when we're talking about power of the bulls or power of the bears. Some people, you know, I've been reading a lot on the internet, coming to me with some quotes of some important people that they've been making about the market. I have to tell you that everything that you do on the market, everything that you do with your personal accounts, will only really reflect to yourself. So basically, you have nobody to complain to for your failures. That's why you clearly need to know which direction the trend goes and where it ends. That's why that webinar is for. Now, if I'm using this particular strategy, I'll most probably end my trading somewhere around here. Okay, I clearly see that the price retraced more than 50% from the previous downward wave, which means it might change to the upside suddenly. You never know, because what you see on the chart is still here. Okay, this side of the chart you don't see it. So you have no idea which way the price will go. The only thing you can do is get out of the market as soon as possible, take your profits, and wait for the next move below that price. Then you can say that the trend will continue. Until then, it's only a sideways move, and the trend can change to the upside. And even the relative strength index during that time is telling you one and the same thing. The price is hovering between the 30 and the 70. That's something that we will talk about in our second part. This is next Wednesday. We will be talking about sideways range. This is where we're going to talk about multiple positions on short and long-term time frames. Basically, because I very much love the sideways range, because on a short time frame it gives you the opportunity to make a lot of money on multiple positions using very simple tools. You will see how that's happening. Now let's pick another instrument and see how it's moving, to see where it's going. Should we say, let's take a commodity. Let's take a commodity. Let's take gold, for example, and then we'll take something else. Okay, we have gold here, the perfect, beautiful yellow metal in a very good 45 degrees angle. Even if you place the from the beginning here on the chart, you can see the trend line is not really going to help you, even if you place it somewhere here. But when you know that the trend goes down, right now it does help you. But what if you use that trend line and you place it, for example, you have one wave, second one here. It's not really going to help you, because the price is hovering around between those levels, as we mentioned on the Fibonacci, as you can see here. And let's extend it a little bit. Okay. Now we can see where the price is going, and we can go to the same technique here to wait for the price to break below it. As you can see, we have our retracement between 33 and 66 around this area, so we can establish our downward trend. Still, that's not very true. Even if you take multiple short positions here, you will most probably end up losing a little bit, because the price is still hovering between those levels for an extended period of time until it goes back down below the zero level, which is the most important one, and then retests it, and then you have an established trend. Now let's see, for example, how the 14 period moving average is going to look like when we use it on this. There you go. Same places as I've just mentioned. You have a bounce off from this one, a lot of opportunities here to trade it. You have the Fibonacci retracement telling you this is not really good time to sell, and the best way to do it is here. For, of course, multiple positions possibility. Now, in addition to that, the relative strength should show us if our trend is valid, if it's good to trade it, or it's probably a larger time frame sideways range. And as I mentioned, sideways range, we're going to cover it next Wednesday. Multiple times we show how the price is bouncing off these levels. So let's clear it, of course, and use the horizontal, the vertical line here. Okay, once the price is not even in oversold conditions, it's staying above and between those levels. Where exactly do we have a better chance of entering? Where the price is clearly moving below the moving average here, and the price of the relative strength is currently telling us it is in oversold conditions. This is from where we can enter a very valid and good position. And I'll tell you why. You see that the price is moving below that moving average without making any kind of excursions above it. Now this is what we don't need. We can't trade a market where it's uncertain. So between this and this period of time, something extremely important, we can't really trade it in a downward or an upward trend. There is no established trend. From over here, the price makes progress, breaks below, stays below the 14 exponential, giving us multiple opportunities to enter the market. Now remember, when we're talking about daily charts, you will very often see that the distance between here and here is 10, 20, 30, $40 probably. So from our entry here, before the price breaks above the exponential moving average, entering in overbought conditions from where the relative strength is telling us the price will either move sideways or it will change to the upside. So we have no idea. After we have an established trend, once you see the 14 exponential price closing above this moving average, aligning in time, let's see how it does that with the relative strength index. We can even wait a little bit here. The relative strength is not quite ripe at this moment, so we might allow ourselves to make a mistake somewhere over here where the price is closing above the 70 level, telling us the trend is clearly over for some time. And if we have only one position during all that time, if we have to measure how much money we've made, we can always do it like this. Now this is $55 of difference for about 34 days. Now this is, yeah, it's 34 days, 35 days. That's average 1 month, 1.5 months, okay? For 1.5 months, $55 change in gold. When we know that with one lot, we can make 55,000. I'm pretty sure people can trade with more than one lot would be very happy to take this opportunity. Clearly, this is something you should remember one more time. When the trend has to validate, when we previously had a low low, like this one over here, as I multiple times mentioned, the price is retracing too far, more than 50% from the current downtrend. Okay, so when it's bigger than 50%, we need to have a validation above this or below this level here to suggest a directional move. From then here we have sideways range, and still we're talking about the daily chart. So as I mentioned, the sideways trend will always work for us to make us a lot of money. I'll show you how the next time. Now, roughly speaking, in this moment you don't have to use a pencil over the chart to draw this. I'm just simply showing it to you, but measuring with the Fibonacci retracement, we can see one more time the price is more than 50% retracement to the upside. Therefore, we can't really use trend following strategy here. We need to use another strategy. Which one to pick? As I mentioned, at the end of the month, everything is connected. We need to follow strictly our appointed webinar topics. I believe we have a time to, let's take a look at another strategy here. I had a suggestion here for USD JPY. One of our very good traders here at the company, he wants to see USD JPY. So let's do it for him. Okay, we have the same, just removing the grid. It's very simple layout. I'm gonna leave the ask line. We still love the ask line. We're gonna switch to the candlestick chart, zoom it in a little bit more, shift it forward. I like to look at it like this. It's a bit better. That's a beautiful explanation why, in this case, the trend line is not really a very good point to use it. First of all, let's measure this from the beginning of the trend. It clearly starts with this long bullish candlestick for the dollar here. We're going to measure the next high, which is over here. Now we have an uptrend. The retracement is between 33 and 66. There you go. We're connecting point A and point B. And we have our trend line. Let's set it up. Yep, sorry. There you go. Even if the trend line is at 45 degrees angle, which is perfect, which is exactly what we need to see. This is the most perfect trend, sustained. Okay, I think I just got you confused here. Should be like this. Okay. The first bounce off from where we enter is here. The price is making a very strong excursion to the upside. And you're saying, okay, the price went too far up too fast. You're cutting off your profits here. Where am I going to enter next when the price just keep going up and up and it has no end to it? And it's just establishing another minor trend here, another minor trend here, which ends over here. So why use multiple types of trend lines and make your life miserable and so difficult to understand? Instead of that, use that perfect trend line, moving average, and it's going to tell you when to enter and when to exit. Still, you have your entry. It's a perfect entry. Bounce off from this one. Beautiful gap here. Another multiple entry here, bounce off, and clearly the trend is over because it moves sideways for an extensive period of time. It's a lot of time here. From November, the beginning, we're using a 1 hour chart. Why am I looking at it so strangely at this moment? We want to use the daily chart here. There it is. Now it looks better. So we start from the beginning. We measure our trend, how we already know to do that. The retracement is between the 33 and 66. We have it over here. Our second one, we already have plotted the moving average. We just want to see how the trend line is going to change our lives at this point of time. There we go. Now, in this steep uptrend, the price is multiple times bouncing off the trend line, also the moving average, but it goes still far away from it. This one still gives us multiple opportunities, and the price closes below it pretty much at the same time when the price will actually breach the trend line. And as we already know, we might wait for a confirmation, a few candlesticks to close, and the price still will go if we decide to wait too much, to our final entry here in wiping its profits, which are quite significant at this point of view on the daily chart. So basically, this 14-period exponential is giving you a better view from where to enter and where to exit from the market. Best to that, adding the relative strength gives you an overview for how long time the price is staying overbought and oversold. Now in this case, in an uptrend, we need to know for how long it's going to be in the overbought conditions. And there it is, stays in overbought. From point A to point B here is where the trend is established. Our first position is here, corresponding in time. Our second one is here, corresponding. The price is still above here. And then when the price breaks below this exponential moving average, it clearly goes in oversold conditions, from where we should consider our exits based on the fact that the price stays for quite some time down here. Even if it goes to the upside one more time, we can still consider multiple opportunities when the price bounces off of this one. So this is quite a good example from taking a present point of view, that if we are measuring that trend, this is probably going to be our new established trend line. Let's really take a look at it. Right now, I don't need to measure it. You're too sophisticated already to suggest that this type of retracement is between 33 and 66%, giving us the opportunity to make this trend line happen. However, the steepness of this moving average will probably give you a better opportunity to enter before the price breaks below the exponential moving average, the trend line, which of course will be a little bit too late for your entries, and the price will be already in a reversal mode. Question here we have. Oh yes, about those questions, as I mentioned the previous time. Whatever questions you might have, you still can just jump straight into it during the session. Please go ahead, because the topic is so big and I want to extend it a little bit too far into different charts, different time frames, as I mentioned. So we can't really have that question and answering session after the webinars. Because the thematics is a little bit too extent and we don't have too much time. That's why we're making these seminars at the end of the month, so we can actually talk about what we've learned so far, whether it's any section of the webinars or the whole strategy together. We can still communicate. You can ask your questions and you can make your explanations freely online by yourself, not only typing those questions to me over the chat. But right now we have a question here. Can 14 moving average be used in 1 hour and 4 hour time frame? That's a very good question. Thank you very much. Let's see the smaller time frames. As we mentioned, this particular strategy is quite accurate on a daily chart because we're using this setup. On the smaller time frames, we can still use it for multiple position opportunities, but we need to always keep an eye on the daily chart, because this is our mid to a major trend. As we mentioned, 3 types of trends with significance and direction. Don't forget it. If you have forgotten it, just review our previous trend following webinar. How it looks on the 4-hour chart. It definitely looks much smoother, so it's not so steep, but it's not at a 45 degrees angle. You can pretty much make the difference if we do like this, for example, from where the trend is, and if we do like this, for example, you can pretty much see that the distance between this point and that point, is not equal. So this is, let's say this is X, this is Y. So in this case, X is smaller than Y. And if we need to have a 45 degree angle should be something like this, in which case X would be equal to Y. So this is our perfect trend, 45 degrees angle. If it's smaller, that means it's too flat. If it's too big, if Y is smaller than X, that means it's too steep and it's not going to be sustained. That's why we need that bigger picture, ladies and gentlemen, because on the daily chart, everything is much more accurate. On the smaller time frames, let's get back to your question. You can just enter multiple positions in the same direction, but you cannot expect the relative strength index to work the same way as it does on the daily chart. You can see for how long time the price stays between the range of 70 and 30, and it's still going up, so you can't really compare these in time. It's not going to be that accurate. If you want to use that particular strategy, only this one, you know, on smaller time frames, you should be using the different setup and the different layout as we presented on our basic webinars. This would be relative strength. Let's disregard this. It was a B, it was an R. Relative strength index will be equal to 14. Don't forget the 1. And then we have Bollinger Bands equal to 3 deviation plus 14 moving average. Okay. Now those things, as we presented the last time, should apply on the smaller time frames. If you are going to follow the layout and the strategy that we were talking about in this advanced month of the webinars, you need to use that layout that I'm saying, and the more accurate the better. So the best accuracy you will get on a daily chart. Smaller time frames, use them for multiple positions. Basically, let me erase that, like all of it. Come on. Get rid of those lines here that we don't really need them. We will take a look at the daily chart. Okay, let's see. This is the layout right now. We want it to get a little down here, okay, somewhere close to that moving average, so we can make our entry. What we need here is to follow the relative strength to be above the level of 70, okay. But when you switch to the 4-hour chart, let's, it is something that I want to do here, okay. Let's put that in line with time, okay. Here is where the trend begins, okay. Where it confirms is here. Did I do something? No, it didn't happen. Where it confirms over here. And checking out on the smaller time frames. You see, what we have here is relative strength between this and this point is between 70 and 30. You can't really use it here. But what you can do is just closely monitor multiple positions. One here, one here. Okay? Now, there it is, another one here. Still, it doesn't correspond with the relative strength. So it doesn't really go so accurate. But what you can do is every time you see the relative strength above the 70 level, that means it's going to be above the 70 level on the daily chart as well. And you can make another position here. There you go. You can use that 14 exponential. Because it's 14 exponential on the previous strategy setup, the one that we've been talking about on the smaller time frame trading. So basically the moving average is something that you can rely down to the 1-hour chart. Of course, the next time when we're going to talk about sideways range, we're going to set up additional tools. We will change the 14 exponential with Bollinger Band. Now there the deviation is not going to be 3, it's going to be different. It's a lot to talk about, multiple indicators we're going to set up. So it's a lot of fun. It's a lot of things we're going to talk about. Thanks a lot as well. I can see you're writing here. Well, I can see that there are no more questions, but first let me go down to the 1-hour chart. I just want you to see personally how it looks like, the same time frames. Okay, so you see, it's not so accurate. You have a lot of entries here, but then the price is moving below the moving average. You need to use a larger moving average to filter those fake outs. Okay, so different time frame needs different setup. So you can still use those different instruments, relative strength, moving average, so on and so on, but the setup is different. And a piece of advice: if you need a better entries, it's very easy to remember. It's smaller time frame, larger indicator levels. Larger time frame, smaller indicator levels. A lot of people will say, "Oh, we need larger levels on the larger time frames." Yes, if you're an investor, if you have an exposure and you're looking to 5 to 10 years per trade, that's another thing. But we're talking about a position that you're going to hold up for 1, 2, 3, 4, 5, 6 months, something like that. Okay, not longer than a quarter of the year. We're talking about an investment that you're going to make and you will collect in the next 2 to 4 months in average. That's why we're talking about an advanced, longer time technical analysis. Because the larger the time frame, the more accurate you're going to get. In any case, as I mentioned, if any of you guys have more questions of these kinds, how to set up those instruments to work on a smaller time frames, which levels you might want to see appropriate in this case, I will be able to help you. You know how it goes. Schedule a one-on-one session or just send me a direct email. We can still do that. Well, that's it for today. I'm very pleased to present one of our first advanced strategies. We're going to continue with the second part, as I mentioned, next Wednesday. Don't forget to sign up. Until the end of the month, I'm going to mention it one more time, everything is connected. Each and one of the individual webinars are connected, and at the last webinar of the month, we will sum that up in a seminar where we're going to talk about your doubts about the strategy, or your doubts about the market, or anything that comes to mind. And of course, a webinar before that is the whole layout, where we're going to use a tool which will tell you which strategy to use at the right time, so you can be always at the right side of the market. That's it. Thanks a lot for joining. Okay, see some more questions are coming in. All right, I will allow the final question here. What is the good time to trade trend? Okay, that's a very good question. However, I don't really understand the meaning of it. What is the good time frame or the good time? Because it's always a good time to trade the trend if it's on a trend. Please clarify that for me. Do you mean the time frame or time of the day? I don't understand. Okay. Until our trader here responds to this in our chat, I would like to also mention something extremely important. That's actually one of our next webinars, which will be after the second part of the directional movement. This would be the advanced find the direction technique. And this is a very good place where we can actually find which direction the trend is going to go. So as I mentioned, everything is connected. First, we had the psychology of trading, where we actually learned to control our emotions and how to avoid them in order to stop making mistakes on the market. Today, the first advanced trading techniques following the trend, part 1, up and downward trend. The second one, advanced trading the trend techniques, part 2. We'll talk about the ranging market next week. And next Friday, advanced find the direction techniques, additional indicators, how to set them up, how to read them, and what they mean. I will let you know next Friday, and that will show you which direction the trend will go, because everything, as I mentioned, is connected, which at the end advanced find the right strategy techniques will tell you which one of those above pointed strategies will be suitable for the right time on the market. Well, that's it. I don't see any reply from you on the question, what is the good time to trade the trend? I would assume that your question is about the time frame. That would definitely mean that every time frame is good to trade the trend. Basically because we have three types of trends. Okay, short-term trends, mid-term trends, and long-term trends. In those different trends you can find additional trends. So it doesn't really matter on which time frame you traded. You need to have a different setup for a different time frame to use that specific type of trading strategy. But as I mentioned, this is not our main topic to go with different time frames. This is only one specific, one specific strategy, one specific chart layout on one specific time frame, and this is the daily chart. When I'm mentioning the smaller time frames, this is something that you can take a look at for a better priced action. So, on a daily chart you see only one candle, or on the 4-hour chart, okay, you see 5-6 different candlesticks per day. Okay, so that means that you have a better opportunity to spot a better price. If the trend is to the upside, you can find a better, in a smaller, lower price, so you can get a better profit. That's another thing that you can use. Me personally, I don't really switch to the charts. You can see where the price started the day. Every time the price is close to the starting, you always go short or go long. That's another idea how you can use it. Okay, we're 3 minutes past the hour. Now there is something else that I want to mention in about 27 minutes. Extremely important news, something that I would recommend for everyone that has positions right now opened on anything connected to the US dollar. Don't forget to pay attention to them. We're awaiting, I'm pretty sure everybody knows, but let me mention unemployment rate and non-farm payrolls for US and Canada. So extremely important, high volatility expected, and of course pretty sure you will witness gaps and maybe spikes on the market. Be prepared. Thanks a lot for joining us. Stay tuned for the next webinar next week. Don't forget to join us. Thanks a lot. Bye-bye.